Every empire, every economy, and every generation believes it understands debt until the pattern reveals itself. Because beneath the numbers we hear in the news, 38 trillion, 315 trillion debts owed across continents, there's a far older design at work. A design woven quietly into the foundations of modern finance over centuries. A design that doesn't collapse when debt grows, but actually requires it. What if the real story of global debt isn't about governments overspending, but about a cycle engineered long before today's leaders were even born? What if the world isn't drowning in debt, but functioning exactly as intended? And once you understand the pattern, you'll see why no country can escape it, and why the next phase is already unfolding. Why this matters right now. Today, the world is facing the largest accumulation of debt in human history. Not during a world war, not during a global depression, but during a period that most economists still describe as stable. And yet, beneath that stability, something unprecedented is happening. Every major economy, the United States, Europe, Japan, China, is now operating on debt levels so high that previous generations would have called them impossible. But instead of slowing down, the system is accelerating. Governments borrow more. Central banks intervene more. Interest payments grow larger, and the cycle tightens. This matters because debt is no longer just an economic tool. It has become the architecture of modern civilization. It shapes elections, directs global power, influences conflict, determines which nations rise and which quietly fall. We've reached a moment where the pattern is visible to anyone willing to look closely. A moment where the decisions made today will shape the financial world for decades. And the question facing every country and every individual is no longer, how do we reduce debt, but what happens when the system relies on it? To understand why the world is here, we have to go back, far back, to the first moment when debt transformed from a temporary burden into a permanent structure. A moment engineered not by kings or politicians, but by the first architect of the global debt machine. Long before modern economies, long before central banks or global markets, debt was simple. A ruler borrowed from wealthy merchants, promised repayment, and either paid the loan or defaulted and started over. It was messy, embarrassing, and unstable, but it was temporary. Debt cleared. The system reset. That world ended in 1694. England was exhausted by war, its treasury empty, its reputation damaged by past defaults. Traditional lenders refused to help. And into that crisis stepped a Scottish merchant named William Paterson, a man whose idea would quietly reshape the financial future of every nation that came after. Paterson proposed something no king had ever accepted, a loan that would never be repaid. Instead, England would pay interest forever, guaranteed by Parliament, enforced by taxation, and managed by a new institution, the Bank of England. This was the turning point. For the first time in history, national debt became a permanent feature, not a temporary burden. The principle didn't matter anymore, only the flow of interest did. And the merchants who funded the loan didn't just gain repayment. They gained a stream of income that would last for generations. England got its war funding. The merchants got an endless annuity. And the Bank of England gained the power to issue money backed by government debt, transforming IOUs into currency itself. This wasn't an accidental innovation. It was the birth of a system where government borrowing wasn't solved, it was sustained. And this first architect created the template that every major power would eventually adopt, often without fully realizing the long-term consequences. But to understand how this single moment grew into a worldwide structure, we need to introduce the deeper pattern beneath it, the framework that reveals how debt evolves, expands, and eventually traps entire nations inside it. To understand how global debt became permanent, interconnected, and ultimately inescapable, we need a clear lens, a way to see the evolution of the system across centuries, not just moments. Because what began with William Paterson was only the first stage of a larger cycle, one that repeats with new players, new institutions, and new consequences, but always with the same underlying mechanics. This cycle can be understood through 4 stages, each one building on the last, each one engineered, intentionally or not, by a different architect of modern finance. Stage 1. The creation of permanent debt. A government borrows not to repay, but to maintain an endless stream of interest. Debt becomes structural. Stage 2. The globalization of debt. What was once a local obligation becomes a web of international creditors, making default not just costly, but dangerous. Stage 3. The expansion of infinite credit. Central banks enter the picture, creating money to buy government debt, guaranteeing demand and removing natural limits. Stage 4. The institutionalization of perpetual indebtedness. When nations can't pay, the system adapts, not by forgiving debt, but by restructuring it and binding economies more tightly into the cycle. Each stage doesn't replace the previous one. It layers on top of it, strengthening the structure and expanding its reach. By the time all 4 stages are in place, debt is no longer a financial tool. It becomes the operating system of the entire global economy. And now that the framework is clear, we can move deeper into the cycle, beginning with Stage 1. The moment permanent debt became the foundation of modern power. Stage 1 begins with a simple but transformative shift. Debt stops being a temporary obligation and becomes a permanent structure. When William Paterson convinced England to accept a loan that would never be repaid, he wasn't just solving a wartime funding problem. He was redefining the relationship between governments and money for centuries to come. The brilliance of his design wasn't in the loan itself, but in the behavior it created. Once a government realizes it no longer has to eliminate debt, only service it, everything changes. Borrowing becomes easier. Spending becomes easier. Expansion becomes easier. And the state becomes dependent on a continuous stream of credit. Paying interest forever meant that lenders no longer cared whether the principal returned. They cared that the government survived, taxed, and kept the payments flowing. This made the ruling government more stable, not because it was strong, but because its survival was profitable to its creditors. Insight number 2, debt becomes currency. When the Bank of England was allowed to issue notes backed by government debt, the system crossed into new territory. The debt itself became money, and that meant the more the government borrowed, the more currency the bank could create. The incentive was clear. Borrowing wasn't a burden, it was fuel. Insight number 3, the psychological shift. People didn't understand at the time, but the government had quietly locked itself into a future where debt would never shrink. Because if it did, the money supply would contract, the economy would slow, and political power would weaken. From this moment forward, governments were not just permitted to remain in debt, they were encouraged to. This was the seed planted in 1694, a seed that would grow into a system so large and interconnected that future generations wouldn't even question its existence. But Stage 1 was only the foundation. The next transformation, the globalization of debt, would turn a national experiment into the beginnings of an international trap. If Stage 1 created permanent debt, Stage 2 ensured no nation could ever escape it alone. And the architect of this transformation was Nathan Rothschild, the man who turned debt from a national arrangement into a continental network. Once governments realized they could borrow forever, the next challenge emerged. How do you fund endless debt on a global scale? Rothschild's answer was simple and revolutionary. You don't wait for lenders. You create them. Insight number 1, debt becomes a global product. Rothschild industrialized government borrowing by buying sovereign bonds at a discount and reselling them across Europe. What began as loans between a king and a few wealthy merchants became a marketplace. Debt wasn't a request, it was an investment product. This innovation meant government bonds flowed across borders into pension funds, insurance companies, and private investors. Suddenly, every major nation's debt became everyone's business. Insight number 2, interconnection eliminates default. Before this era, a king could default, accept the embarrassment, and move on. But now a single government bond might be held by investors in 5 different countries. A default didn't hurt one creditor. It risked collapsing an entire network. The more interconnected the system became, the more dangerous non-payment was. Default wasn't just expensive, it was destabilizing. Insight number 3, control through information. Rothschild's courier network, famously faster than many governments, allowed him to understand financial conditions before the public did. This wasn't insider trading as we define it today. It was information dominance. In a world where debt linked nations together, whoever controlled information controlled the market. Whoever controlled the market controlled the terms of future debt. The globalization of sovereign bonds didn't just spread financial power, it centralized it. Governments became dependent not just on domestic support, but on the confidence of an international web of investors. Stage 2 expanded the cycle. Stage 3 would remove the final limit, the amount of money available to lend. Stage 3 insight, the expansion of infinite credit. By the early 1900s, the world had permanent debt, Stage 1, and globally interconnected creditors, Stage 2. But there was still one natural limit left in the system. Governments could only borrow as much money as actually existed in the banking sector. That limit vanished with the arrival of the next architect, J.P. Morgan, and the creation of the Federal Reserve. This was the moment debt stopped being restricted by available capital and became constrained only by political will. Insight number 1, central banks turned debt into money itself. Before 1913, U.S. banks could only lend what they held. After the Federal Reserve was created, the central bank gained the power to create money to buy government bonds. This meant government debt was no longer limited by savings, gold reserves, or the capacity of private lenders. If the government issued a bond, the Fed could simply create new dollars to purchase it. Demand became infinite. Insight number 2, borrowing became risk-free for governments. Once the central bank could guarantee purchases of government bonds, the natural brakes disappeared. In the old system, interest rates rose sharply when borrowing became excessive. Investors demanded higher returns for higher risk. But now, the central bank could suppress rates by unlimited bonds and ensure debt stayed cheap. Debt expansion became not just possible, but safe. Insight number 3, the market never clears anymore. In a traditional financial system, if borrowing became too high or economic conditions weakened, the market forced a correction. Debt levels fell, spending slowed, and the balance restored. But with central banks backstopping the system, corrections became politically impossible. Instead of letting the market clear, the Federal Reserve could intervene, inject liquidity, and keep the cycle running. The result: debt never resets. It only accumulates. Stage 1 made debt permanent. Stage 2 made it global. Stage 3 made it infinite. But there was still one problem. What happens when a nation can't even afford the interest? That's where Stage 4, the age of perpetual restructuring, emerges. By the late 20th century, the global financial system had already passed through 3 irreversible stages: permanent debt, globalized creditors, and infinite central bank support. But a new challenge emerged, one that threatened the entire framework. What happens when countries simply cannot pay? Enter Paul Volcker, the architect who ensured that even unpayable debt would never be allowed to disappear. His actions in the early 1980s didn't just stabilize the U.S. economy. They cemented a new global rule. Debt must always be serviced, even when it cannot be repaid. Here's how the final stages of the cycle formed. Stage 4, debt becomes non-optional. When Volcker raised interest rates to nearly 20%, developing countries saw their debt payments triple overnight. Nations like Mexico, Argentina, and Brazil couldn't even cover the interest. In previous centuries, this would have triggered mass defaults and a system reset. But instead of allowing the reset, Volcker and the IMF created a new path: restructuring. Countries were given new loans, not to fund growth, but to keep making interest payments. Default was replaced with dependency. Insight: debt was no longer a financial obligation. It became a mandatory subscription. Stage 5, sovereignty becomes negotiable. The IMF didn't provide bailout money for free. In exchange for debt relief, countries were required to implement structural adjustments. Privatize national industries. Cut public spending. Remove protections for local businesses. Devalue the currency. Open markets to foreign capital. These conditions ensured that creditor nations and global banks gained deeper access to the debtor's economy. Insight: debt became a mechanism of influence, a way to reshape national policies without firing a single shot. Stage 6. The trap becomes global. What Volcker tested in the 1980s became the template for the next 40 years. Greece in 2010. Argentina across 2 decades. Sri Lanka in 2022. Each time, the formula repeated. Unpayable debt, IMF intervention, austerity, loss of sovereignty, more debt. The trap stopped being a coincidence. It became a global operating system. Insight: whether debt is too high, too interconnected, or too unpayable, the system adapts not by resetting, but by tightening the cycle. The 4 architects unintentionally built a structure where debt cannot be paid off, default cannot be allowed, and escape cannot be permitted. Now that we've mapped the entire cycle, the next step is to ground it in the present moment, where we stand today in this centuries-long pattern. Today, the world is not entering the debt cycle. We are standing at its most advanced stage, the point where every component built over 300 years operates simultaneously. For the first time in history, every major government runs on permanent debt. Every major financial system depends on bond markets to survive. Every central bank acts as a guaranteed buyer of government debt. And every nation is interconnected through a web of creditors and institutions. This is not a temporary situation. This is the system working exactly as designed. Here's what defines our position in the cycle. 1. Debt is no longer measured in trillions, but in stability. The United States owes $38 trillion. Japan owes $9 trillion. Europe owes over $14 trillion. Global debt exceeds $315 trillion, more than 3 times the world's economic output. Yet markets remain calm. Why? Because investors, institutions, and governments all agree on the same unspoken rule. The debt doesn't need to be repaid, only serviced. The system survives as long as confidence does. 2. Central banks have become the backbone of governments. When crises strike, recession, pandemic, banking panic, central banks purchase trillions in government bonds, creating new money to stabilize the system. This isn't an emergency tool anymore. It's standard practice. Debt issuance and money creation are now 2 sides of the same coin. 3. Nations cannot default without global consequences. In the past, a country could default and move on. Today, a single default means pension funds lose value, banks face insolvency, currencies swing violently, and international markets destabilize. This interconnectedness means no major country is allowed to fail. Instead, they are refinanced, restructured, or quietly supported, even when their debt has clearly reached unsustainable levels. 4. Interest payments are becoming the new tax. Governments worldwide now spend increasing portions of their budgets not on services, development, or infrastructure, but on interest payments. These payments flow upward to asset managers, banks, pension funds, and institutions that rely on government debt for stable returns. Debt has become the world's most reliable and invisible wealth transfer mechanism. 5. The system can no longer shrink. If governments try to pay off their debt, the money supply would collapse. Markets would freeze. Economies would contract. Unemployment would skyrocket. In other words, the system cannot move backward. It can only expand. This is where the cycle places us today. An era where global stability depends on perpetual debt, endless refinancing, and an unspoken agreement that the system must never reset. But if this is where we are now, what comes next? If the past created the cycle and the present sustains it, then the future becomes a question of trajectory, not possibility. Because every stage of this system points toward the same conclusion. Debt is no longer an event. It is the environment. And when debt becomes the environment, 3 future trends become nearly impossible to avoid. 1. Debt will continue expanding, by design, not dysfunction. The global economy now depends on debt growth to function. If borrowing slows, the money supply contracts. If the money supply contracts, economic activity falls. If economic activity falls, the political foundation of nations weakens. So the future isn't defined by debt reduction. It's defined by managed expansion. Governments will issue more bonds. Central banks will intervene more frequently. Budget deficits will become normal, not exceptional. The goal won't be balance. It will be stability through controlled inflation and continuous borrowing. 2. Crises will be managed, not resolved. In the old world, a financial crisis forced a reset. In the new world, crises force more intervention, more liquidity injections, more central bank purchases, more restructuring, more coordination between countries. The system cannot afford a reset anymore. It can only extend the timeline. Future crises, recession, currency pressure, housing corrections will be solved with the same tool: larger, more institutionalized debt. 3. Power will shift quietly toward institutions holding the debt. When governments rely on constant borrowing, real influence flows to those who fund and manage that borrowing. Central banks, global asset managers, insurance and pension giants, multinational financial institutions, sovereign wealth funds. These entities don't run for office. They don't campaign. They don't need votes. Yet they increasingly shape the financial landscape of entire nations through the simplest mechanism in the world: the price of borrowing. In the future, the true balance of power won't be determined by who governs, but by who finances those who govern. The future is not collapse. It is continuation. Many imagine a dramatic reckoning, a point where global debt becomes too large and everything breaks. But the more likely scenario is quieter. A world where debt grows year after year, where interest payments rise, where nations become more financially integrated, and where the system becomes more dependent on confidence, stability, and central bank coordination than ever before. This is not the end of the cycle. This is the next phase. And understanding is the difference between being swept along by the system or learning how to navigate it. Understanding the debt cycle isn't about predicting collapse or panicking at large numbers. It's about recognizing the rules of the system and positioning yourself intelligently within it. Here are the practical, grounded takeaways that emerge from a world built on permanent, global, and ever-expanding debt. 1. Focus on assets that benefit from monetary expansion. If governments must continue borrowing, and central banks must continue supporting that borrowing, then long-term monetary expansion is almost guaranteed. In such an environment, assets that hold value as currency weakens become increasingly important. Broad market index funds, productive businesses, real estate in strong locations, commodities with long-term demand, intellectual property and digital assets. The system isn't designed for saving cash. It's designed for leveraging capital. 2. Understand that taxes and inflation are the true costs of the system. Since governments cannot repay debt, interest must be serviced through taxation, inflation, borrowing from new generations. Recognizing this helps you adjust expectations. Inflation is not an anomaly, it's a feature. Living costs rise. Currencies lose purchasing power. The most effective response is to hold assets that rise with inflation rather than fall behind it. 3. Strengthen your financial resilience. The system rewards preparedness. You do not need to predict the future to prepare for it. In a world where debt cycles move in predictable waves, individual stability comes from building an emergency fund, maintaining diverse income streams, reducing high-interest personal debt, increasing skills that remain valuable regardless of economic shifts. Resilience is the modern form of sovereignty. 4. Pay attention to central banks. They are the real signal. Most people follow elections, politicians, or headlines. But the real direction of the future is shaped by central bank rate decisions, liquidity injections, bond purchase programs, currency coordination, Regulatory changes. These decisions don't make loud headlines, but they quietly reshape the financial world more than any election cycle. 5. Stop expecting the system to reverse. Learn to navigate it instead. The debt cycle is not going away. It will not reset. It will not suddenly shrink. The better question is, how do you operate intelligently within a system designed around permanent expansion? The answer lies in understanding the incentives. Governments must borrow. Central banks must stabilize. Institutions must search for yield. Individuals must protect purchasing power. Knowing this gives you clarity and advantage. The further you look into history, the clearer the pattern becomes. Debt isn't a mistake of modern governments, or a failure of leadership, or a problem waiting to be solved. It is the architecture the world now runs on. A system built slowly, deliberately, and layer by layer across more than 3 centuries. A system shaped by choices, incentives, and innovations that still define the global economy today. Once you understand the cycle, you stop seeing debt as chaos and start seeing it as design. You recognize why governments borrow endlessly, why central banks intervene predictably, and why the world grows more interconnected with each passing decade. And instead of reacting with fear, you approach the future with clarity and the ability to navigate it with intelligence rather than confusion. If this breakdown helped you see the world differently, and you want more deep, long-form explanations about how global systems really work, from money and markets to power and policy, make sure to subscribe. There's far more to uncover, and the deeper you look, the more the patterns reveal themselves.